soggy outing this morning. Technology ignoring that rally that we saw stateside of the Nasdaq. Our technology stocks this morning falling by just over 0.6. Financials are weaker again this morning. A number of the big banks still housed in that basket of stocks around financials, down 0.5%. We've got banks also joining the mix of underperformers, again down 0.5%. And its usual suspects, Sabadell again in Spain towards the bottom of the basket. Deutsche Bank, Barclays travelling lower, BBVA, BNP Paribas, Santander, all trading in the red at the start of the session. Media stocks were down 0.4. The chemicals basket giving up a fairly modest 0.25%. Autos travelling down by about 1/10. The exception BMW is towards the top of that basket. Food and drink slightly lighter, but we do have some gains in some of the big brewers like Carlsberg and Heineken. Food companies too, Danone moving into the green. Three performers to the upside. Utilities up by about 0.25%. Similar ranges on that versus healthcare, and the top performer telcos right at the top of the boards. Let's take a look at what we're seeing at the individual indices. The starting point for the UK, don't forget it is budget day here. We're waiting for some details from the Chancellor that could focus on more assistance for childcare, reforms to pensions, but also a bit to tackle the cost of living crisis, where we have a huge number of strikes again occurring today. So we've got the FTSE cautious, 7,600. We've given up a lot of territory, just reversing off that 8,000 point mark, as you can see in the recent number of weeks. The percentage drops, though, very similar to what we're seeing on the French market, down roughly 0.5%. A little bit less coming off the likes of the DAX, just moving down by about 1/3% to the periphery. Spanish stocks under pressure. We've got selling in Italy just over 0.5% or 140 odd points, only slightly weaker for the Zurich stock market. BMW on our radar in the auto space. It has confirmed its preliminary results for 2022, posting an EBIT of 10.6 billion euros. In its guidance for the year ahead, the German car maker said it plans to keep vehicle prices steady. Our colleague Annetta caught up with the CEO of BMW, Oliver Zipse, and asked him how much room the car maker has to pass on costs as it focuses its strategy on luxury cars and EVs.
We have a global strategy. We have an almost equal footprint in Europe, in Northern America, and all of Asia, including China, of course. And now the revenues we look at, it includes the revenues from BBA, our joint venture in China, where we own now 75%. And we create revenues out of that global perspective, but also out of all segments. The lower segment, the middle segment, and the upper segment, and the super luxury segment like Rolls-Royce. And at the same time, we look at all drivetrains, and that is a positive development. We don't look at one drivetrain or one segment or one region in the world. And I think for us, this plays very nicely into what we said a couple of years before, and now we're executing this plan. And it looks like the plan we are doing here is quite successful on the revenue side, but also on the market share side. We look at market share, but at the same time at profitability, and that works out, as you see, very nicely for us.
Let's take a look at H&M. Right at the bottom of the Stocks Europe 600, net sales picked up in the months from December to February, slightly beating analyst expectations and rising 12% to over $5.2 billion. The fast fashion retailer continues to cut jobs and other costs amid rising inflation after it saw profits fall last year. H&M has so far avoided passing on higher prices to customers. The stock, as you can see, weaker in trade. This is the German listing of 0.6%, but I can tell you, looking at other listings on the market, it is down heavily, down 4.4%. I want to take you to Inditex. The early reaction was -2 and the stock is down 3.1%. Net profit rose 27% in 2022 to 4.1 billion euros as sales at the world's largest fashion retailer topped 32 billion euros. The Zara owner benefited as consumer spending picked up post-pandemic, and the retailer was able to pass on rising input prices to shoppers. Not a great outing today, Charlotte, for some of the retailers as investors react to the numbers.
Yes, I guess there's a bit of certainty out there, but if anything, Inditex has shown there's kind of a resilience there in their business model, and there's a bit of a reassurance to a certain extent because it's the first full year numbers under Marta Ortega, the daughter of the founder of Inditex, who took the helm of the group. There was a bit of question mark on whether she had it to be at the head of the group. And here we see, as you said, net profit up 27% last year to 4.1 billion euros, sales up 17%. So there was all these numbers were in line with expectations. expectation. The gross margin was down 8 basis points to 57%, and operating expenses up 15%. Again, reflecting here some higher costs, including staffing and rent. But they have managed, and one of the key there at Inditex compared to some of the competitors, including H&M, that they've been hiking prices quite aggressively last year and passed it on to consumer, and that hasn't impacted sales so far. So they have a bit more wiggle room there. That's, for example, H&M again, that is facing more competition from some of their fast fashion retailers like Shine, etc., etc. So here Inditex has been able to pass on some of these costs more increasingly. So they have about 5,800 stores as they continue with the optimization there. They have shut down stores in the past year, a plan that they announced a couple of years ago, pushing for digitalization and online sales as well. Another interesting point that they've been pushing into the US quite aggressively, and in the release this morning they mentioned that this is significant long-term opportunity in the US. They have about 100 stores right now. They want to increase this by 30 stores in the next couple of years. So very much focusing on this market there and looking at the first signs for the spring. They said their spring-summer collection has been well received, with sales up 13% for the past 6 weeks. And they announced this new dividend of €1.20 per share, so up 29% compared to last year. So overall, all this also remembering that they shut down the operation in Russia. They had about 500 stores in Russia. They put a 230 million charge there after the shutdown of the operation after the war in Ukraine. But overall, you see numbers in line with expectation with for Inditex.
Disappointing reaction though, isn't it? You've got the analysts saying that they think margins can be protected, but that is one that has an upform rating on the stock. If you look at the sales numbers, the third quarter was an 11% level. That was a slowdown versus 16% from the same quarter earlier in the second quarter. So it does suggest that what we're seeing even on the numbers now, that you've got to step up in the sales print. So it's interesting to see what investors are reacting to.
Yeah, and all the analyst notes I saw this morning say strong numbers in line with expectations. From the guidance that they gave, they said they see a 3% increase in store space. Again, in line with expectation, a stable gross margin by around 50 basis points. So all this kind of semi-reassuring on the numbers there. And as I said, again, their model being quite nimble at Inditex. They have very close supply chain, unlike, again, some of their competitors in Spain, in Turkey and Morocco. So they've been able to be very, very flexible and very nimble on their supply chain. They're, again, being able to pass on to their price cost. So their whole business model has been quite resilient there. And that kind of reflects when you compare to H&M. But still, I guess, a bit of uncertainty out there on consumer purchasing power for consumers, with inflation still very much here.
Charlotte, thank you very much for that. I've come back to the wall to show you some of the other big numbers we're watching this morning. This is around the luxury space across here in Europe this morning. It's mostly a negative picture. The exceptions really are Hugo Boss and Pandora eking out slight gains, although Hugo Boss looks to be giving that up right now. While the overall print is weaker, bellwethers in the basket of stocks from Kering to LVMH, both tracking weaker. China's post-COVID year is off to a slow start. Retail sales for the first 2 months of the year grew 3.5%, in line with expectations. Industrial production for the period rose less than expected, while fixed asset investment topped forecasts, but investment in real estate sank more than 5.5% in the period. That followed a 10% fall for all of last year. So the reaction you're seeing to some of the China numbers in the luxury space this morning. Well, Moody's has cut its outlook on the US banking sector from stable to negative after a stock market rout saw global financial stocks lose almost $500 billion in market value in just 2 days. The ratings agency said its move reflected the rapid deterioration in the operating environment after the collapse of SVB, Signature and Silvergate banks. Look at the big banks here in Europe this morning. We are seeing a pickup in Credit Suisse that has bounced 0.2%. We're hearing from the chairman today in a panel with our colleague Hadley. HSBC, this is the bank that stepped in to rescue SVB UK. It's pushing higher by about 0.1%. And Commerzbank, one of the hard-hit areas of the European banks, it's also managed to put in a slight gain. Elsewhere, we are seeing losses still on this wall. SocGen, one of the weaker ones, down about 1% plus. The rest of the range is more modest to the downside. On a different note, UK Chancellor of the Exchequer Jeremy Hunt is expected to set out measures to tackle growing economic inactivity and early retirement in his spring budget later on today, amid conflicting